Welcome to Factful Finance, where we break down the world of finance to help you make smarter decisions with your money. Have you ever wondered how the stock market really works, or why bond investments are considered safer? Well, today we're diving into the three primary types of financial markets: the stock market, the bond market, and the money market. These markets are the backbone of global finance, and understanding them is key to building a solid financial future. Let's get started. Before we dive deep, a quick disclaimer. The content in this video is for educational purposes only. Always consult with a professional for personalized advice. Let's kick things off by breaking down the stock market. This is probably the most familiar to many of you. When people talk about investing, they often mean buying shares of a company in the stock market. Stocks represent ownership in a company, and buying shares gives you a stake in the business. This market is where investors go to buy and sell stocks, and it's what most people think of when they hear financial market. The stock market has two primary exchanges in the United States: the New York Stock Exchange, NYSE, and NASDAQ. These are the platforms where buyers and sellers meet, either directly or through brokers. A big advantage of stocks is their potential for growth. For instance, if you had invested $1,000 in Apple's stock in 2005, you would have seen that investment grow to over $50,000 by 2020, assuming you held it all that time. But, as rewarding as stocks can be, they come with their risks. Prices can fluctuate wildly, and there's always a chance the value of your investment might drop. Next, let's turn to bonds. Bonds are often seen as a safer alternative to stocks. When you buy a bond, you're essentially lending money to a government or corporation in exchange for periodic interest payments and the promise of getting your original investment back after a set period. Bond markets are crucial for governments and corporations to raise funds. For example, if the U.S. government needs to build infrastructure or fund a public project, it issues bonds. One of the key benefits of bonds is their stability compared to stocks. If you buy a 10-year U.S. Treasury bond, for example, you can generally expect a steady return with less risk than investing in stocks. The downside? Bonds tend to offer lower returns than stocks, especially in a low-interest rate environment. That said, they can be a great way to balance a more volatile stock portfolio. Lastly, let's talk about the money market. The money market isn't something most people think about, but it plays a critical role in short-term financing. The money market consists of short-term, highly liquid investments that are typically low risk, such as treasury bills, certificates of deposit, and commercial paper. If you've ever had a savings account or a money market fund, you've interacted with this market. Investors use the money market to park cash temporarily, usually for a few months or less. The primary appeal of the money market is its safety and liquidity. Money in these instruments is usually safe from loss and can be accessed easily. The downside? Returns are lower than both the stock and bond markets, making the money market more of a tool for managing short-term cash rather than a long-term growth strategy. So, how can you use these markets? Let's look at a practical example. Sarah is 30 years old and just starting to build her investment portfolio. She decides to allocate her funds into stocks for growth, bonds for stability, and a money market fund for her emergency savings. Over time, she watches her portfolio grow, balancing risk and reward. Now, what if Sarah had chosen only one of these markets? If she only invested in stocks, her portfolio would be subject to higher volatility. If she chose only bonds or the money market, she would miss out on higher potential returns. The key takeaway here? A diversified approach, using stocks, bonds, and money market instruments, is a smart strategy for long-term financial health. And remember, diversification isn't just a buzzword, it's a strategy that many successful investors swear by. Whether you're a beginner or have been investing for years, you can benefit from understanding the nature of these markets and how they can work together. As you think about your own financial goals, keep these markets in mind. Want to get started with investing? You could open a brokerage account for stocks, invest in bonds through bond funds, or put your short-term savings into a high-yield money market account. Before we wrap up, let me ask, what's your financial strategy for this year? Are you focusing more on stocks, bonds, or maybe even a mix? Let us know in the comments below. Thanks for tuning in to Factful Finance. If you found this video helpful, consider subscribing so you don't miss out on more expert financial advice. Until next time, stay informed, stay savvy, and take charge of your financial future.